how much money do you need to open an IUL? My name's Daniel. Last year we did 1.3 million with index products. Here's what you need. First, we're gonna look at the minimums by age, gender, and health, and I encourage you to look at them for each age. You'll see why that's important in the end. But there's two numbers we're gonna look at. First is how much money you need to actually open the policy, and then much more importantly, how much money you need to max fund a policy so that you can have the tax-free benefits. First, the male is always going to be more expensive than the female. You'll see that continued throughout the video. And you'll see here, we just put a standard rating for both the male and the female. That is because from age 0 to 18, you get juvenile rates. You cannot get a preferred rating for exceptional health. That's because, well, a baby is much more likely to die than a healthy 18-year-old. There's a little more risk associated with being an infant, with being younger. So you can see here, first, the numbers are on a monthly basis, a little over $100 for the male, a little less than $90 for the female. Keep in mind, and you'll see this through the video, this is the minimum you need to max fund, but it would behoove you to go well above the minimum for maximum funding. Of course, the more money you put in, the more this money is going to grow tax-free. Second, we jumped ahead beyond juvenile rates, age 18. We're gonna look at 4 different categories here. First is the standard rating for a smoker, standard non-smoker. If you're pretty healthy, you can get a preferred rating, and if you are very healthy, you can get preferred plus. Some companies have one even a little bit higher than this. But what you'll notice is when you're young like this, look at the minimum amounts to max fund. About the exact same for all 4 classes. That's why, and you'll see this as the video continues, even if you're unhealthy and get a very poor rating, as long as you can qualify, you can still be able to max fund this policy and reap all of those tax-free benefits. You might have less death benefits, but that's not why you're doing it if you're max funding. The minimum here, just to keep the policy alive, you can see very small difference in all 4 cases. Now let's look at the female. First thing you notice, again, the same 4 classes here, but the max fund number and the minimum numbers are going to be much lower. Again, that's because women are much likely to live longer and are much healthier than men statistically. Now let's look at age 30 for the male. We're gonna have different little ratings here. First is a standard smoker. This is with a table D rating, essentially someone who is well below your average health and is a smoker, so keep that in mind. Next, standard non-smoker, and then the last 2 we kept the same. So you can see here it's going to increase a little bit as you get older. We have a little over $200 for max funding, about the same on the rest of them, and then a little less than $100 for the minimum funding. The only reason you should ever care about what the minimum funding is because this is the number that you can fall back to if a hardship comes, you aren't able to continue funding the policy. So in this case, let's say someone was max funding a policy for the minimum, so $202, they were a standard smoker table D. They got 5 months into this policy, so they paid a little over $1,000 total into this policy, but for whatever reason, they weren't able to put in the $200 next month. Well, the good news is the minimum that you need to put in each month is just a little less than $100. So in this case, since he's 5 months in, he's put $100 in 10 times, so he's good for the next 5 months. So technically, you could take a break for the next 5 months without funding this policy at all. It's going to stay in force. However, of course, the goal is that you want to max fund the policy so that more money is going to grow that you'll have later on, but you have that to fall back on. Now let's look at the female. As you'll notice, much lower, as you'll see with all of the ages here, but 171, again, 169, 169, and 169, staying pretty close regardless of what the health of this 30-year-old female is. The minimum, $80 to $78. Age 50, let's look at the male. We have the same rating classes again. So first, the standard smoker with a table rating of Class D, $363.48 at a minimum. A little bit more of a difference here, so all the way up to preferred plus, we're gonna see as low as $340, and then the minimums are ranging from $165 to $149. Again, remember, these are the minimums that you can max fund the policy with, but it would behoove you to put much more than this in, $1,000, $2,000, $3,000 a month. That's how the money is going to grow. And if seeing these minimums going up by age is of concern to you, it shouldn't be, because if you're wanting to use this money for tax-free income later on and you're starting later, well, you're going to have to put more in because it has less time to grow. Where if you started when you were 18 years old, putting $100 a month in might have gotten you much farther by age 60 than if you started by putting $400 a month in at age 50. Next, the female, a little bit lower again. $309 is going to be the lowest if she's a smoker and table D, all the way down to $292 if she is in the preferred rating, ranging from 130 to 142 in the minimums. Of course, the goal is you don't have to fall back on these, but you have that there. Now let's look at age 60. You can see it's obviously getting a little bit higher here for a smoker. Again, in bad health, still the minimum is not that high, $540 here, all the way down though to $481. So a little bit of a difference you're gonna see here in terms of the minimum the older you get, but the discrepancy is also going to be more because the amount of money that you're putting in is more. The minimum here, $215 on the low end, all the way up to $250 on the high end. Same example here, if this person was putting in $1,000 a month, got 5 months into the policy, they have now put in $5,000. Something comes up, they can't put in $500 the next month. Well, the good news is the minimum is $250. If you divide this by $250, what you're gonna see right away is this covers over 20 months. So if this happened 5 months in, this person would not have to fund the policy for another 15 months and it would still stay in force. Of course, you don't want this to be the case, but something you can fall back on. Now for the female, we see here the standard smoker table D is $455 a month. Then the preferred plus gets it down to $427. The minimums are gonna range from $220 to $195. One thing I wanna note, with all of these numbers I'm showing you, this is just with one specific company. The numbers are going to vary from product to product, from company to company, from strategy to strategy. However, they're all going to be just about exactly these numbers I'm showing you. Now let's go even as you get much older into age 70. With this example, the minimum for the standard smoker at a table D rating is a little over $800. The minimum for preferred plus is down to $740. All of these examples, by the way, since they're the minimum, are going to get you a starting death benefit of $50,000. That's going to continue to grow over time as you're putting money in. And then when you're done funding the policy, you're going to switch it to level so it's no longer going to get any bigger until the cash value catches up to a certain point. And you want that to happen so the cost of insurance doesn't get out of control. That's why you can still open these policies even when you're much older and still get very similar internal rates of return to as if you had opened it when you were 18 years old. The minimum in this case, $319, and the worst, all the way down to $285 for the preferred plus. For the female, however, you're gonna see this is much more preferable, $762 for the standard smoker table D, all the way down to $661 for the preferred plus, minimums ranging from $285 to $268. This is something that's important to keep in mind, and especially for couples who might be considering a policy much later in their life. I have clients, for example, where the father is the one who owns the policy, wants to be one to access the money, who's funding the policy. However, we make the insured the wife because the wife is able not only in some cases to get a better health rating, but even if it's a worse health rating, still get a little bit lower cost of insurance and higher death benefit. With everything I just showed you though, you do need to consider these things. First, this is a long-term vehicle. So even if you're starting this at age 70, it might be something that you're planning to take tax-free income for the next 20, 25 years. You have to keep that in mind from day one. If you're trying to earn a big rate of return in the first 10 years, it's just not going to happen. You want to use this policy the same way that big banks are using this policy, that big entrepreneurs are using this policy, that successful tax-free income takers in retirement are using this policy. That is playing the long-term game, funding the policy as quick as you can, letting the money grow, taking that income tax-free, and not expecting to see big returns in the first couple years. You have to keep that in mind. Second, max funding is crucial. Yes, we showed a lot of the minimums, but if you're not max funding these policies, they aren't going to give you as much tax-free income as you might have wanted otherwise. They're not going to give you as much capital for your business if you're trying to use this as a working capital account. You need to be max funding these policies. If you do a little bit less than that, that's fine. The policies are still gonna work well, but the goal should be, I'm gonna max fund this policy and get this money in. And since max funding is so crucial, that means if you are able to put in $3,000 a month into a policy like this, maybe you should just be putting in $2,000. That way, if something comes up, you're not able to put that full $3,000 in, you're gonna be fine because you're still getting just the $2,000 in and you're still max funding the policy. So you don't necessarily wanna put the highest amount that you could put into this policy, but instead you wanna find that number and then reduce it a little bit. Next, lastly here is, what is your goal with this policy? Are you using it to build cash value to take tax-free income later? Are you using it as a working capital account for your business? Are you using it as an emergency fund, as an alternative to the bank, keeping it in the same place that banks keep their liquid capital? These policies are not magic. They cannot do all of these things just as well as the other at once. They can do all of them, but if you're using it for tax-free income and you take out a big lump sum to use as working capital for your business that you never pay back, well, it's not going to get you as much tax-free income as you might have planned, since you were trying to use it for multiple different purposes. Are you trying to do this, one, not only to get your money tax-free, but two, because you want protection from market losses? You don't want to deal with market volatility, the ups and downs of the markets, feeling like you have to coach yourself every time the market goes down to just hang in there and wound up getting your average investor return, since people never seem to actually buy and hold, of 2 to 3% before taxes, before advisor fees, but instead to be at peace. If that is the case, you need to keep this in mind, along with it being a long-term vehicle, so that you can see at your annual reviews, when your agent hosts those, to go and look at how your policy has performed, that you're not going to be shocked that you didn't make a big gain in the first year, in the second year, but instead you're comparing things to the initial illustration and seeing how you're on track to be able to take the income you had planned. Next, the maximums here really quickly. Generally, you can get up to 40% of your net worth or income, but it varies. It's going to depend person to person. This is determined by financial underwriting. So if you're earning less money, that percentage might be a little bit lower. However, for the higher earners, it's going to be much closer to that 40%. Regardless, just as we said, max funding is crucial. The structure of this policy to make sure it accommodates the amounts you're trying to max fund the policy with is also very important. This means that the agent who is opening this policy for you needs to have the most amount of money possible that you are putting in going towards the cash value, and the least amount of money possible going towards the death benefit. If it is not structured this way, not only is your money not going to grow as this video demonstrates it can, but the agent is going to get a much higher commission. So some agents will do this intentionally. You need to look out and make sure the policy is structured properly. You don't just trust your agent because he's a nice guy, but instead you know he knows what he's doing. If you'd like to take a look at what a policy could look like for yourself, how much tax-free income you could take, book a 20-minute quick consult with myself down below. I'd be happy to help out.